Tripp, because this is going to affect a ton of people. We've seen this for a long time, but it's really coming to a head right now.
Absolutely.
State Farm, the country's largest insurance company that writes homeowner insurance policies, says that they're going to quit writing those policies completely in California starting yesterday. Now, you may find this is odd, but it's not really. And the truth is, this decidedly is not just a California problem.
Which so many of them happen to be. But anyway, State Farm General Insurance Company, State Farm's provider of homeowners insurance in California, will cease accepting new applications, including all business and personal lines, property and casualty insurance, effective May 27th, 2023. This decision does not impact personal auto insurance. State Farm General Insurance Company made the decision due to historic increases in construction costs outpacing inflation, rapidly growing catastrophe exposure, and a challenging reinsurance market.
Now, we have fires out here in California on a scale never before seen, and a remarkably inept state government that has exacerbated a really bad situation. I think this has been well documented. It's the other part of what State Farm's statement said that should concern everybody.
It doesn't even make any sense!
You do not need to get that personal.
And that's the cost of construction and reinsurance market that affects all policies in all states, but more importantly, all insurance companies. In short, State Farm's move in California today can be your insurer in your state tomorrow.
And it's going to happen. You need not look any further than Florida, which has found itself with only a scant number of insurers still willing to participate in the state because of hurricanes and the dreaded cost of construction and reinsurance market costs. And of course, all of this will make the cost of insurance higher absolutely everywhere.
Now, it should be understood that high construction costs are not really that high. We need to quit saying that. These costs are now the norm. In fact, possibly low. The cost of construction goods like comp roofs, framing wood, steel, and cement have all come down, yet premiums continue to go up.
So here's a graph of construction costs as it pertains to your insurance policy's replacement costs. This is a merger of Zillow's cost, the Case-Shiller Index cost, and as you can see from really 2013 to basically now, home construction costs have gone through the freaking roof. I mean, this graph looks like the ramp Evel Knievel used to jump the fountain at Caesar's Palace in Las Vegas, and we know how that sucker turned out. These costs, my friends, they're not high. Man, this is scary, but it's the norm.
Reinsurance, if you're unaware, is a reimbursement system that protects insurers from very high claims. It usually involves a third party paying part of the insurance company's claims once they pass a certain amount. Reinsurance is a way to stabilize an insurance market and make coverage more available and affordable.
So clearly high cost areas are going to be hit harder, yet with the cost of construction permanently higher, we can only assume the cost of reinsurance will remain high, and that's a cost that will simply be passed down to the consumer if they can even get insurance in their state in the first place. So what to do? This is always the point of our show and our message to our realtor and lender partners out there watching right now. The takeaway for your clients is listed with a 12-point bulletin in a link down below. And it really is what we already know, and this is something we absolutely should be sharing with our clients. It's you can change your deductible, make it higher to bring the cost down, especially when it goes through the roof.
Sure.
You can shop insurance to make sure you're getting the best rate. You want to make sure that you're bundling your insurance. We hear that on the news all the time. And you want to make sure that you have a clear line of communication open with your realtor partner, your lender partner, because they know these insurance folks, and your insurance agent.
You know, it's also a really great reason to reach out to your sphere of influence. Tell them every year, because their insurance agent probably isn't. Tell them that they need to go look at their policy. They need to make sure that they're not underinsured. And this is a great message and reason to reach out to your people that will be appreciated and reciprocated in turn.
You know, this is making a long show even longer, but you're absolutely spot on. That was one of the points in the 12-point bulletin that we have connected here. You bought a house maybe from mom and dad, and you bought it for 50 cents on the dollar, or you bought your house 6 or 7 years ago. That's not the cost to replace that house today if it were to burn down or get hit by a hurricane or a tornado or any of that stuff. You could be wildly underinsured right now and not even know it.
Money wins. Here's to us.
Well, and it's not necessarily just your reconstruction cost. It can also be your contents cost. I mean, think about how much more expensive couches and clothes and everything else, appliances and things are. So you really need to tell your people, share the message, get out there and check.
Lenders, realtors, we can't stress this enough. This is the perfect opportunity for you to reach out to your insurance folks and your past client database. Your insurance policy needs a tune-up right now.
It's also a great opportunity to share a database with a local insurance agent who might want to help you with that situation.
Lots of good stuff here, guys. Make sure you do something today. Ready? 1, 2, 3, hike. Hey guys, you don't want to miss this upcoming Friday. Oaktree's going to be doing a webinar on catering to the self-employed borrower.
This is Chris Martin with Oaktree Funding. Hope you're having a great day. I want to talk to you about a new webinar we've got coming out, talking specifically about probably one of the most underserved communities in our country, self-employed borrowers. We have tons of programs that can help you. And this webinar is going to be brought to you by 25 plus year industry vet Damian Fisher on our team is going to do a whole rundown of how we can help you structure deals for more self-employed borrowers. We've got 1099 programs, 3-month bank statement programs, all the way to 24-month bank statement programs. We've pioneered these programs in many cases, and many investors out there have actually copied our guidelines. This is going to be a great webinar. Hope you register for it. Click the link below, and we'll see you there.
It's going to be 9 o'clock Pacific time. It's going to be 10 o'clock Mountain time. It'll be 12 o'clock Eastern time. It's all the same time. And of course,
Don't forget 11 o'clock Central Time.
you get the idea. Make sure you're there. Click the banner.